Thousands of everyday people are making six figures with Forex trading, and you can be one of them. But yes, I know how daunting it can be diving headfirst into the world of Forex trading. Sure, the wins can be massive, but the losses can be just as devastating if you don't know what you're doing. And that's why today I've gathered all of my knowledge over the last 5 years of Forex trading and helping hundreds of people make trading their full-time career. And in this 2-hour-long course, you're going to have everything you need to get started Forex trading and potentially make thousands of dollars. But first, you need to understand what Forex actually is. Now, Forex is obviously the abbreviation for foreign exchange. And this is because it's the market where all of the world's currencies are traded against one another. You might not know this, but Forex is actually the biggest financial market in the world, with over $6 trillion being traded back and forth on a daily basis. But there are tons of other types of trading out there. And yes, all of them can make you thousands of dollars in profit. But after years of trading, I've realized that Forex is something that all beginners need to master. And here's why. Now, I mentioned it before, but because the Forex market is so big, there are millions of traders running trades at the same time. Now, because of this, it means that you can get in and out of positions really quickly, even if they are really big positions. And one of the reasons why people like trading Forex so much is because the market is open 24 hours a day. Unlike the stock market, where it's got set opening and closing times. But personally, I started trading Forex because of the low barrier to entry. And I know this is true for a lot of people. But when it comes to stock trading, for example, there's something called the pattern day trading rule. And this means that you can only trade if you have $25,000 and above. Now, I don't know about you, but I don't have that lying around in my back pocket, especially when I was working an entry-level job in a mall. So, trading a few $100s in an account seemed like the most doable thing for me. And that's what trading with Forex brokers allows you to do. It was also a very easy way to be introduced to trading because Forex pairs generally move a lot slower than other assets. This means that it can be a lot less risky to trade and a little bit easier to predict the movements of the market while learning how to trade and deal with trading emotions. So after years of teaching myself all of the trade secrets, I've learned the best time to trade Forex. The Forex market opens at 10 p.m. GMT on a Sunday evening and then closes up again at 10 p.m. GMT on a Friday evening. And that includes all major financial centers, whether it be London, Tokyo, New York, or Sydney. Now, there are a few optimal trading sessions that you need to be on the lookout for, and this is generally when two sessions overlap. And mine, along with everybody else's favorite, is when the London and New York trading sessions overlap. And this is generally between 8 a.m. and 12 p.m. Eastern Time, or 1 and 5 p.m. GMT. And the reason people call these times optimal times is because there are thousands and thousands of people getting in and out of trades at these times. It's the most popular time to trade. And because of this, you'll be able to get in and out of positions a lot easier because of the abundance of traders. This means that liquidity is high, and we'll talk about this a little bit later in this course. And as a result of this as well, it means that the spread is a lot lower when trying to trade. And now the spread is essentially the difference between the bid and ask price. So where you get into a trade and where your trade is actually filled. So there's a small gap between those two executions, and that's your spread. Now that is a lot smaller when we trade during these times because of the high trade frequency. And this means that it costs you much less to get into trades during these optimal trade times. So now you understand when to trade Forex. It's now important to understand what you're actually trading. So in Forex, you don't trade individual currencies. You're trading what we call currency pairs. Now, a currency pair is essentially where you compare the value of one currency to that of another currency. For example, euro to the US dollar. This essentially is telling you how many US dollars you can get for a euro. Now, your job as a Forex trader is to determine which of these currencies are going to be stronger and which is going to be weaker, and then buying the correct currency pair that will allow you to benefit from this move in the market. So if you think that the euro is going to become stronger, you need to make sure that you buy the euro US dollar pair, because you're going to benefit from this particular currency pair increasing in value. Now, the euro US dollar pair is one of the many Forex pairs that you're going to come across during your Forex trading journey. And there are essentially three major types of currency pairs that you need to know about. So the first type of currency pair that you need to know is major currency pairs. Now, this usually involves the US dollar, as this is basically what the whole world runs on. And these currency pairs have the best trading conditions because they are the most popular. And as we've spoken about before, the more volume, the easier it is to get in and out of trades. Some examples of this include Euro US dollar, GBP US dollar, and USD JPY. So the second type of currency pair is minor currency pairs, and this doesn't include the US dollar. Now, these kinds of currency pairs generally have a lower trade volume than major currency pairs, hence the name minor. However, they're still pretty widely traded. So some examples of these kinds of pairs is the euro versus the GBP. We've got euro versus the Australian dollar, as well as the Great British Pound and the Japanese yen. And lastly, we have exotic currency pairs. Now, exotic currency pairs usually include one major currency and then one currency from an emerging or third world country. And as you can imagine, these pairs have a lower trading volume or liquidity, and this means that it can be harder to get in and out of trades. And the cost of getting into these trades is going to be higher, or the spread. So because of all of these factors, it is actually riskier to trade these kinds of currency pairs, especially if you're a beginner. An example of a currency pair like this is the US dollar versus the South African rand, or the US dollar versus the Mexican peso. And out of all of these, can you guess which one that I'll suggest that beginners trade? It's obviously major currency pairs, and that's because they're a lot easier to predict. Their price movements less risky to trade because of the high trade volume, as well as the fact that the spreads are lower and it's going to cost you less to get in and out of these trades. Currency pairs is one of the first things you need to learn as a beginner trader. But if you really want to get started trading, you need to understand a few more things. So here are some basic trading concepts. Now, these are things that you're going to hear on all trading YouTube channels, and they're going to be repeated over and over. So understanding them is crucial. Now, even if you're not a trader, you've probably heard of the terms bullish and bearish. To keep it simple, bullish essentially means that the price is going up, and bearish means that prices are going down. So for most traders who are buying assets, a bullish market is usually a very good thing. It means that over time, that asset is going to slowly build in value. Now, if you're taking long positions in the market, please know that a bullish market is a very good thing. Taking long positions essentially means that you are buying that asset and expecting the price to increase over time. So in other words, when you are long, you own that asset and you are benefiting when the price goes up. So here's a quick example. If you buy 100 shares of a particular asset, you are now long 100 shares. On the other hand, you can also be short on the market. Now, hear me out. This is a little bit more complex to explain. But essentially, all it means is that you are borrowing an asset, selling it at a predetermined price, and then hoping that the price of that asset decreases so that you can buy back that asset at a cheaper price, therefore able to pocket the difference. So essentially, you are benefiting from that asset decreasing in value. One thing to understand about being a short seller in the market is that it's a little bit more of a risky strategy to use. So for example, if you borrow 100 shares of company stock and sell it at a certain price, it means that you are short 100 shares of that stock, and you benefit from the price of that stock decreasing in value. So those are some of the basic terms that you really need to understand to get started trading. Now we're going to jump into the fun part, and that's understanding the different types of trading and how you can actually make money with trading. So there are two main categories of trading. So the first is short-term trading, and this is essentially trades that last anywhere between a few minutes to a few hours. And you're going to benefit from small moves in the price of that asset. Now, while these trades can finish fast and you can make a fast profit with them, it is important that you are very aware of everything happening within that asset and you are able to micromanage that particular trade. Now, the second is long-term trading, and these kinds of traders hold trades for weeks, months, sometimes even years. Now, this can be a bit more of a relaxed way of trading because you don't need to micromanage your positions as much, but the downside is that you need to be extremely, extremely patient for these trades to play out. But there are three other ways that you can classify different styles of trading that I prefer to use. So let's have a look at them. The first is scalping, and this is essentially short-term trading, but on crack. Essentially, you're in and out of trades within a couple of minutes, sometimes even seconds, and you're benefiting from very small price movements. Now, the next is day trading, and it's become quite popular as of late because people are able to get in and out of positions in a day, and this enables them to avoid some of the risks of holding positions overnight. Now, day trading needs a lot of dedication, and you need to be on the charts hours and hours per day. And this leads people to having to quit their day jobs to pursue day trading full time so that they're available to manage their trades and be on the charts every day for hours and hours. Now, there's also swing trading. Swing trading is a lot more relaxed in terms of trading style, and you're holding trades for days, if not weeks at a time. Now, the reason it's called swing trading is because you are trying to capture major swings in the market. And essentially, you're holding these trades for a long period of time, benefiting from these major price movements. So as you can see, there's a lot of different types of trading that you can look to implement. But for beginners, funnily enough, I actually recommend scalp trading. Now, you might be a little bit intimidated by the fact that it is so quick, but there's a lot of benefits to scalp trading. And the reason I prefer scalp trading is because I can get in and out of a trade very quickly, and I only need to be on the charts for 45 minutes to an hour per day. And what this allows me to do is get done with all of the things that I'm doing in a day and not have to sit on the charts all the time, firstly. And secondly, it allows me to have time to process the trades that I've taken. So for example, if I take a trade today and it doesn't work out for me and I'm upset about it, I'm not going to hop straight into another trade after that. I'm not going to be on the charts after that. I'm just getting off the charts. And this allows me to make less emotional decisions when it comes to trading. And as I'm sure some of you have heard, emotions when trading is very important because emotional decisions are usually bad decisions. But we'll talk a little bit later about that later on. No matter what style of trading that you decide to go with, there's going to be a few common things that all trades have in common. And that is that of the concept of pips and the concept of trends. Now, a trend is essentially the general direction that a market is moving in. And there's basically two separate directions, and that's an uptrend and a downtrend. Now, obviously, if you're in an uptrend, price is moving upwards over time. And if you're in a downtrend, price is moving downwards over time. But there's also sideways trends, and these sideways trends can be very risky to trade because there's no clear direction in the market. And your job as a trader is to figure out what the trend of the market is and trade with that trend. And as a lot of traders will know this saying, the trend is your friend. Now, another thing that you should take note of is the concept of a pip. Pip stands for percentage in point, and it's the smallest movement that a currency pair can make. And for most currency pairs, the pip is the fourth decimal point in the number that represents the value of that particular currency pair. And pips are very important because they help you measure really small movements in the value of that currency pair. So now we're going to talk about analysis, and in particular analysis for beginners. And this is usually the part that chases away most beginner traders. But I'm going to show you the absolute easiest way, because if you learn to analyze charts properly, you're going to be better than 99% of beginner traders. So the first type of analysis is technical analysis. Now, technical analysis is essentially the practice of using historical price movements to predict future movements in price. And in order to predict future price movements, traders need to use charts that show how price has changed over time. Now, there are a ton of tools that traders like to use to make sense of these charts. And essentially, the most popular ones are that of support and resistance. There's also supply and demand trading. There is candlestick patterns, and there are trend lines. But one of the most popular methods of analyzing charts is by using what we call indicators. Now, these are mathematical calculations based on the price and volume of that particular currency pair or asset. Now, these mathematical calculations can help traders predict future price movements. A few examples of this is the volume weighted average price, or the VWAP. There's also the RSI, or relative strength index. We also have moving averages, as well as that of other more complicated indicators like the Ichimoku cloud. I personally recommend that you start with technical analysis, and this is because it is a lot more visual and clear. There are entry points and exit points based on the visual representations on the chart. Technical analysis can also be applied to many different timeframes, such as the minute, hour, or even daily time frame. Now, I've personally always gravitated towards technical analysis because it is more data driven. It is a lot easier to create a technical and mechanical system with technical analysis, basically meaning that you can trade more like a robot. Basically, if X happens, I then do Y. Having this kind of mechanical method for trading can make you trade with a lot less emotions, allowing you to make clearer decisions in the market. And so analyzing charts has always been the bread and butter of my trading. Now, the other type of analysis is fundamental analysis. And this is essentially using the news surrounding these assets to trade and predict future price movements. Generally, you're going to make use of things like inflation, interest rates, and GDP growth when it comes to fundamental analysis. And this can become way more advanced and nuanced. And essentially, this means that you're going to be speculating a lot more. It's a lot harder to create a more objective trading system around fundamental analysis, because these news events can be very, very vague and hard to predict. So let's say we're going to start off with technical analysis. Let's start showing you how to analyze trading charts. So obviously, charts show how price changes over time. And one of the easiest types of charts that you can learn to read is Japanese candlestick charts. Each candlestick on the chart represents a specific time period, like a day or an hour. And the candlestick shows you four important things: the opening price, which is where the price started, the closing price, which is where price ended, as well as the highest and lowest prices during this time. You can determine all of those factors by simply understanding a candlestick's two main parts. The first part is the body, and this is the thick part in the middle. It shows you the difference between the opening and closing prices. Now, you've also got the wicks, or the shadows, and these are the thin lines that stick out from the top and bottom of the body. They then show the highest and lowest prices that were reached in that time period. Now, you'll notice that candlesticks usually come in two different colors, and these have their own meanings as well. So green candlesticks mean that price closed higher than when it opened. And red candlesticks mean that price closed lower than when price opened in that specific time period. Now, the reason why candlestick charts are so useful is because you can spot candlestick patterns within these candlestick charts. And this can help you predict whether the price is going to go up or down in future. Now, there's a few examples of different candlestick patterns that we're going to go over down below. Here are a few candlestick patterns that you will see in a bullish situation. So the first is the bullish engulfing pattern, which is a small red candle followed by a big green one. We've also then got the hammer candlestick pattern, which looks like a hammer with a small body and a long lower wick. This essentially means that price tried to push down but failed and then closed up near where it started opening. We've then got the morning doji star, which is 3 candles that look like a star in the morning sky. We've also got bearish patterns, and they can appear as firstly a bearish engulfing, which is the opposite of bullish engulfing, which is a small green candle followed by a big red one, essentially meaning that price tried to push up, but then completely went the opposite way, meaning it failed to go higher. You've then got what's called dark cloud cover, which is a long green candle followed by a red one that covers part of it. Essentially, again, price tried to move higher, but failed to move higher and has mostly come all the way back. You've then got the shooting star, which looks like an upside down hammer candlestick pattern. And this again simply means that price tried to move up, but failed to move up and has now closed down. Price isn't always going to stay bullish or bearish. It's sometimes going to go up and down and range in between. And so this is why you need to understand the concept of support and resistance. Now, support and resistance are essentially levels on the chart where price tends to hesitate and reverse in the opposite direction. Now, support is basically downward price that then hesitates and reverses upward again. And then resistance is essentially upward price that then hesitates and then reverses in the opposite direction. Now, these are really important concepts to understand because they can give you entry and exit points in the market that are extremely precise. They can also help you in placing your stop loss orders, which can help you stop taking unnecessary losses during your trading. Right, so let's talk about support and resistance as well as the concept of imbalance or a fair value gap. So these are two very different terms here. So what we're going to start off with is support and resistance. Now, support and resistance is essentially just where price decides to turn around at. So if it's deciding to go upward and it decides to react at a certain level and turn the opposite way, this point here is what we call a resistance zone, and it continues, price generally continues to go like this. Okay, so support is the floor here where price turned around at when going down, and resistance is the ceiling where price decided to go at. Now, what do you notice in this example? Well, this ceiling that is starting from here turns into the floor of this here. So what happens generally? Okay, support turns into resistance. And this is the cornerstone of the entire strategy that I trade. Support and resistance, also known as breakouts. Okay, and we'll talk about ranges as well a little bit later. But essentially, when we are looking at support and resistance, support can turn into resistance. So for example, this resistance here turned into a support here. Okay, price broke through the zone, came back, retested it, and then bounced off of it. Okay, so this ceiling turned into the floor for the next move. Okay, so basically this here would be a resistance, and then this here would be support. Okay, So that's basically what we are looking at when we're looking at support and resistance. Obviously, I'm going to show you some examples on the chart as well. And of course, of course, there are examples of price pushing down and then coming back as well. But basically what you need to know is that a support and resistance zone is essentially where price is moving upwards and then creates a reaction at that point, okay? So basically, if it's going up and it just starts turning the opposite direction, it means that there is a resistance there, okay? And what we want to be doing is looking back in price to see where two or more support or resistance zones are lining up. So for example, that will look like the following, okay? Let me get the correct tool here. Don't know why I don't have it. So essentially it will look like so, okay? So price moved like that, okay? If you look to the left, these two areas basically line up with one another. Let's make it even clearer. That is a support and resistance zone that is strong because it has bounced at this level and bounced at this level. Then guess what happens in future? Well, it bounces at this level as well. Why? Because it's a significant area, an area of significance, okay? So support and resistance is essentially stronger when there has been multiple reactions at that level. We can then expect in the future for price to continue to react at this level, okay? And that is support and resistance in a nutshell. Now, what I'm going to do is show you on the charts examples of this. Now, where we usually look to mark up higher time frame support and resistance is the 4-hour. Now, what can you guys see straight away? You guys can see that price pushed up here and turned very drastically at this point. So that is a clear resistance zone, okay? And how I would draw it generally is like this. And guess what happens here? Price taps into this zone and then turns away from it. Taps in, turns away, and eventually breaks through. Then what does price do? Price comes back down, taps on the zone, and pushes upwards again. So you can see price reacts here a lot. What does it do in future as well? It then pushes through and starts to react here as well. So price likes to react at the same zones. And I can guarantee you, if I look left, guess what? Price bounced here and pushed up once again, okay? So it's very important that we mark out these zones, okay? Now, one of the most important things that we teach in our mentorship is that you need to draw your support and resistance zones from the top of the wick to the body, the average body height, okay? That's what I generally do. I find the zone basically here. So what I like to do is change the chart to a line chart and look at how much clearer that is for you, okay? You can clearly see this is where price tapped and turned away from. Price tap, turned away. Price tap, turned away, okay? What do we see at this level? Price taps, turns away. Look at what price does here. I mean, you can't make this up. Like, look at how clean that is. Taps, moves away, comes through. Taps, goes down. So it's very important to take note of these areas. Okay, so having it in a line chart like this actually makes it a lot easier. Okay, so let's go back to the candlestick chart, and you can see once again it's very clear that this is where prices turn around at. And so what I like to do at these zones, so you can first spot them using the line chart like this, okay, and draw them up. You can see you can even extend this a little further. See, price roughly bounced here and turned up. Okay, what I like to then do is go back onto the candlestick chart, then find the average place for this zone. So what you can see is this is the wick on this candle here, and we try to include as many data points as possible, okay? So you can see there's a wick that's sticking out here a little bit. I'll cover this a little. and then we'll stretch it back. I don't want to stretch it all the way to the bottom here just to include that, because then the zone is going to be a little too big. But this is essentially how I would draw a zone out. And you can see that whenever price gets into the zone, it starts to reverse. Gets to this zone, bounces, and reverses. Okay, so that is how I draw up an area of support and resistance. We don't just have support zones and resistance zones, because areas of support often turn into areas of resistance in the future. So it's a support and resistance zone to me. Now, if we talk about the concept of fair value gaps or imbalances, what is that? Okay, I'm going to give you guys a brief rundown on those. So essentially, those are just, it's basically a 3 candle pattern. So we've got candle 1, candle 2, and we've got candle 3. Okay, I'm not going to make them red or green. You can see these candles. Now, it's what happens between candle 1, candle 2, and candle 3. So what we will be looking at is the relationship between candle 1 and candle 3. So these can also have wicks, by the way. So for example, here's a wick. And you can have say this one has no wick. This one here can have a wick as well. So basically, the fair value gap or the imbalance is between the opening price, okay, the highest price of candle 1 and the lowest price of candle 3, okay? So candle 3 could also have a wick down here as well, by the way. But essentially, this is the gap that is created. Price has not come back to full orders here, okay? And so what we can hypothesize by that is then when price gets down here, firstly, price tends to gravitate itself back down to this area to pick up lost orders that have been left behind, okay? And when price eventually comes back here and fills these orders, it will then have some kind of reaction and go up. That's the hypothesis. That's the whole theory of imbalances and fair value gaps. Now, what this means for us, though, is that if, for example, we're taking a position up here, okay, taking a position up here, we don't want to necessarily get in here if there's a gap just below our entry, because price often gravitates to get to this zone and then pushes up. And so we use these fair value gaps, all these imbalances, to kind of allow us to place our stop loss in a better place when we are trading the strategy that I trade, okay, which uses support and resistance zones to get in. So let me show you an example of that. So essentially, you can see that over here, we've got candle 1, candle 2, and candle 3. Where would the fair value gap be? Well, it would be the top of candle 1 to the bottom of candle 3. So there's the bottom of candle 3, and here's the top of candle 1. Okay, so this is the gap. So what we can hypothesize is that price is going to come down here, fill this gap, and then have some kind of reaction. Okay, and that is an imbalance or fair value gap, essentially. Speaking of managing risk, it's one of the most important parts of trading. If you're not going to learn how to risk manage properly, you may as well just give up right now, honestly. So here's how you get started with risk management. Risk management is essentially the way that you protect your capital, allowing you to stay in the game long term. And risk management shouldn't be something that you avoid either. Even the biggest traders in the world take losses. It's how they deal with those losses that set them apart from amateur traders and frankly gamblers. So here is how you can improve your risk management while trading. So firstly, you're going to determine how much you want to risk per trade. And as a rule of thumb, we usually risk between 1 and 2% of our trading capital. So if, for example, you've got $10,000 in your account, you're only going to be risking between $100 and $200 for every trade that you take. So the next thing to take note of is your risk reward ratio. Now, this ratio refers to the ratio of how much you're going to win versus how much you can potentially lose. Now, what you're going to want to do is aim for a positive risk reward ratio of at least 1:2. This again means that what you stand to win is a lot more than what you stand to potentially lose. So if you risk, for example, $100 on a trade with a 1:3 risk reward ratio, you are risking $100 to make a $300 potential win. Your winning amount is therefore 3 times higher than your potential losing amount. Now, the next important part of risk management is cutting your losses early. And the key tool to use with this is a stop loss order. Now, this is essentially an order that you place at a predetermined price, which will automatically close your trade and protect your trading capital. So here's a quick example. If you buy a stock at $50 and you place your stop loss at $48, this means that the only amount you can lose in this scenario is $2. So your account is protected and you're not going to lose more than $2 on this particular trade. So before you even enter a trade, you need to determine how much you are willing to risk and therefore how much you are going to win in comparison to how much you are losing. And it's important to have a positive risk reward ratio. And for a rule of thumb, try to go for at least a 1:2 risk reward ratio, because again, you want to be winning more when you win than when you lose. Now, above all, starting small is very important. And the best way to start trading is by trading a demo account with a broker. Now, most brokers offer a demo account option, which allows you to practice and become proficient with the platform, understanding what their particular spreads are like and how smooth their platform is. And this can allow you to practice your edge and see it play out in real time.
Okay, so let's talk about what's called risk management, okay? Now, risk management is the practice of making sure that you win more than when you lose, okay? In my opinion. You can also win less than when you lose, meaning that if I am prepared to lose $100, that on that same trade, I am going to potentially win, for example, $200, okay? So really what we're talking about when we talk about risk management is we're talking about risk reward, okay? Risk reward. That's a really important term to understand. Okay, so when you understand risk reward, it basically means that what you're prepared to risk versus what you're prepared to be rewarded with. So when you are charting on TradingView, you can have this drawn out quite nicely and visually using this risk reward tool over here. Now, what this essentially represents is down here, what you're risking versus what your potential reward will be, which is up here. Okay. So if you have a look at this, you've got a 1:2 risk reward ratio, which people usually call RR. Okay. So your RR on this is 1:2. Okay. So you've got 2 here, and we've got 1 here. Okay, so that means that if, for example, down here, we are risking, let's make it nice. Okay, we're risking $100 here. Okay, that means that when we win, we're going to be rewarded with $200. And it continues on like that. So if, for example, we're risking $2,000 here, we're then going to be rewarded with $4,000 here. Okay, so it's important to bear that in mind. So what we want to do at the end of the day, generally, is have a positive risk-reward ratio. okay? Having a positive risk-reward ratio means that you're kind of skewing the odds in your favor, which is really important, as I'm sure a lot of you will realize. So when you've got your risk-reward tool out like this, essentially like we spoke about earlier, when price is going into drawdown over here, into this red zone, you are now in the minus, okay? But if price is going into this zone up here, which is often green, you're then going into the positive, okay? So that's also something to remember, those of you who are beginners, okay? Some people get confused with this potential tool. You need to be very, very familiar with it. Now, when you are managing risk, it's important, like I said, to have a positive risk-reward ratio, whether that be this here being only 1.5 times your risk. So here we would be risking $100. We would then be rewarded with $150, okay? So it's important to have a positive risk-reward. Now, some people do have a negative risk-reward, which essentially means that this would then be flipped around, okay? This would then be flipped around, basically meaning that I would be risking, for example, up here, this would then be the red part over here. This would then be the red part. So we would then be risking, for example, $200 only to potentially gain $100. And that is a negative risk-reward ratio, which is not something we generally want. There are a few people that use negative risk-reward ratios, but they generally have a high win rate, which is quite a lot of pressure to put on yourself. Okay, so let's talk about win rate in relation to your risk-reward ratio. So your risk-reward ratio, generally positive, okay, is going to have an impact on your win rate because, again, this trade here that has a positive risk-reward ratio of 2:1, okay, this is going to have a particular type of win rate. Now, this win rate is going to correlate directly to the risk-reward ratio. So, meaning, if, for example, we had a trade that looked a bit more equal, so a trade that, for example, had a 1:1 risk-reward ratio, you can then more expect to have a closer to 50% win rate, okay? But that depends on many different factors, including the strategy and the different parameters of your strategy, okay? So for the strategy that I use, I'm using a 2:1 risk-reward ratio, and that is represented by this tool. Okay, I hope you guys understand. I try to break it down as basically as possible. Now, what this essentially means is that you could lose a whole bunch of times. You could have lost, for example, 5 times. And that would be, for example, if you're risking, okay, $100 per trade and you've lost 5 times, that means that you've lost $500, okay? So you've lost 5R, okay, which is 5 times your risk, which means you've lost $500, okay? All you need to do to make that money back is win 2.5 times. So you need to win 2.5R, which equals $500, because remember, we're winning 2 times what we lose, okay? So we're winning 2 times what we lose. So again, that just shows that you can lose 5 times and only have to win 2.5 times to regain that. And that's the power of having a positive risk-reward ratio, okay? Now, in terms of prop firms, is a different thing altogether, because remember, taking all these trades on one account is going to, be quite hard on your psychology. And this is what people have done for a really long time, is take all their trades across one account. But when you have prop firms that make use of virtual accounts that still pay you out, and that you have no loss liability for, okay? And if you guys want to understand a little bit more about that, I have created a video on it. It goes over the secrets of prop firms. But essentially, what you need to know is that prop firms, they don't give you live accounts. They don't give you live funding. They pay you out based on that, though. And that's the beautiful thing. You get 80% of what you make on those prop firm accounts. And so what we can do is leverage this. Because if we've got multiple prop firm accounts, okay, so let's say we've got at least 3 or 4 prop firm accounts. For the example of this, we've got 4 prop firm accounts. What a lot of people do is a little dumb. They'll go for a 200K account right out the gate. That's not smart. Going for a 200K account right out the gate is not smart because you're then putting all your eggs in one basket. What I recommend is getting 4 50K accounts instead. Okay, because if you can pass all of these accounts, which by the way is doable, there are many different ways to do it. If you can pass all of these accounts, you are now basically guaranteeing that at least one of these accounts you can bank some profit on, because you're not going to be taking all the same trades on all of these accounts. You're going to be diversifying your risk. And this is one of the secrets and one of the things we teach you in our program is diversifying your risk. Firstly, we show you exactly how to get funded. Okay, and I mean exactly, and I mean a way that you can replicate over and over and over and kind of churn out accounts like crazy. And then we show you how to manage them, and this is exactly how we do it. So essentially what we do is we split our risk between these accounts. And so even if you're only right half of the time, you're still going to make a ton of money. In fact, if you are right only 40% of the time, you're still going to make a ton of money as well. So what I'm going to do here is kind of show you an example of if we only win 40% of the time on these trades that have a 1 to 2 risk reward ratio, meaning we win twice as much as what we're risking on that trade. With a 40% risk reward ratio, you can make a ton of money implementing this kind of risk management strategy with prop firms. And again, the beauty here is that one loss on one account does not mean you're down, because again, it's not your money. So that's the important thing to remember here. So what I'm going to do is go to random.org, and then I'm going to show you guys, okay, we're going to take trades based on random number generator, and I'm going to show you guys how this works. So essentially, if we get a number of 4 and down, that means that we've lost the trade. That means that we've won the trade, sorry. If we get the number 4 and down, we've lost the trade. If we get the numbers 5 and up, no, sorry, I'm wrong. If we get the numbers 4 and down, we've won the trade. If we've gotten the number 5 and upward, we have lost the trade. So we've got a 60% chance of losing here, but a 40% chance of winning. But because we've got a high win rate, we are then we've then got an edge on the market essentially. So here are our 4 accounts. Let's have a look. So let's say we take our first trade. Let's generate a random number. We get a 4. So it's actually a winner. So if we're risking, for example, $1,000 per trade, okay, no, we're not risking $1,000 per trade. We're risking 1% of these 50K accounts, which is $500. So we won the first trade, which would mean we win 2 times $500, which is $1,000. So we've already banked $1,000, okay, which is absolutely great. Then what we're going to do is put a box around this because it is now safe. We are now putting this aside and only trading these 3 accounts, okay? Then we're going to take a trade on this next account over here. So we're going to hop onto random number generator again. And the random number is 6. So we've taken a loss, which is minus 500 here. We're then going to take another trade on this next account, okay? Let's generate. We also take a loss, okay? Minus 500. We're then going to take a trade on this next account. Okay. We've also lost that trade. Okay. We've now got a loss on each of these accounts. Not a problem because we've got a positive risk reward ratio. So then let's go back on to number generator, generate. We got a 4, which is a winner. So guess what? We're now plus 500 on this account, okay? Because we won $1,000, okay? And what I'm going to do now is also bank this because come payday, we can then actually take all the profits from these 2 accounts, okay? So we're now going to work on only these accounts here, all right? Let's continue to take trades. That's a 2, so that's also a winner. Okay, so now we've got another $500 on this account right here. Okay, and now we're just going to work on getting this account here into a profit as well. Let's take a trade on it. Okay, we took another loss. So that means we are now at minus 1,000. But then we took a winner, which means that we are now at 0, at break even, because we made $1,000. Let's take one more trade. And that's a winner as well. So we are now up $1,000, okay? So overall, very risk adversely, we have made we've made $3,000, okay? And that is a really good result. Now, what you can do from here, though, is where it starts to get really spicy because you've got all of these accounts in profit. You can start to be a bit more aggressive, for example, on one, because you've already booked $2,000. So we can then book these accounts off here, wait for payday, and then become a little more aggressive on this one account over here. So we're up $1,000 on this account, okay? We're up 1,000. So what happens if we perhaps risk, the full 1,000, okay? And in fact, what we could even do, we can risk 1,000, which is 2% of this account, which is still fairly risk averse. And then if that works out, we can really cash out. So that's essentially what we can do. So we take a loss on that, okay? So then we are now at 0 again. We take another trade on it, and it's a winner. So we've now won $2,000 on this account, which is 4%, which for me is a high withdrawal, okay? So in total, oops, let me change that. That's disgusting. We've got in total, got $5,000 here, okay? Sorry, $4,000 here. 4,000. Which is a really great result for having all of these accounts and doing it very risk-free with only a 40% win rate and a 1 to 2 risk reward. Seriously, like that's not insane numbers. It's not insane to have a 40% win rate with a 1 to 2 risk reward ratio. So now that you guys understand risk reward and you understand risk management, okay, as well as win rate, you can start to kind of put the pieces together in terms of creating a systematic approach that has statistics and numbers behind it. And we're going to talk about collecting that data through collecting past data on the charts, and we refer to that as backtesting. So I'm going to show you how to do backtesting, collect these results, and kind of build confidence and statistics behind your trading, which is really important and builds confidence in your edge as you trade it live.
So you're going to need to use TradingView if you want to be a trader. That's just one of the staple things, one of the most important softwares you're going to need to know. So essentially there is 2 very important parts to TradingView, and that is the drawing panel over here on the left-hand side. Okay, you've got all of your drawing and navigation tools on the left. And then you've got your watch list panel over here, okay? And that's how you're going to be able to change between various different instruments that you're trading. So essentially what you're going to want to do first is organize your watch list panel. Now your watch list panel is going to determine all of the different asset classes that you can access quite quickly. So you can see I've got NASDAQ, I've got US 30, I've got GBP, JPY, I've also got gold here, and then I've also got futures as well that I can access. Now, what you're going to want to do first is, once you've decided what you're trading, so for example, if you want to trade GBP, JPY, and you want it to be here in your watch list, what you're going to want to do is click on add symbol, look for GBP, JPY, and then you're going to want to click this plus button next to it. Now, what you'll notice is that there is different feeds. So these are the different broker feeds. So within the Forex environment, there are different broker feeds. So you've got here Pepperstone, you've got IC Markets, you've got 8cap, you've got FXCM, you've got Oanda, and you've got Capital.com. Now, what I recommend to you is to use the one that is closest to what you're using. So for example, if you're trading on a prop firm that uses 8cap, use 8cap, all right? If you're using Vantage as a broker, use the Vantage option, because then your feed is going to be the most similar to that particular broker. You'll find that all of these are very closely, they're very closely correlated, all right? And you can see there's lots of different brokers available here. You can use Think Markets, you can use 8cap, whatever suits you. All right. What you will find though is that if you use FXCM, you'll probably get the most, it's going to suit most of these brokers, but they are all a tiny bit different, but it's not that big of a deal. So I personally use the FXCM one. So you'll just click on the plus and click add to watch list. You'll then find that this gets added to your watch list. And then you can continue to add other symbols that you want to trade. So for example, if you want to trade Euro USD, you can then add that. So I can then click add, and then you'll see Euro USD is now on my watch list as well. And then you'll see if I want to switch to Euro USD, I simply click there. And if I want to switch back to GBP JPY, I just click there. So it's that simple. Now, let's have a look at some of the other features within TradingView. So if you want to close out this so that you've got more of a clear view of your chart, you click here, okay? So you can see my chart isn't quite standard. It has this line running through it, all right? And that is an indicator. That is the 50 moving, the simple moving average. And that here is represented in the top left corner, okay? So you can see here, I've got the SMA, which is this line here, which is a moving average like I spoke about earlier. So how we get that is pretty simple. So if you want to put an indicator on the chart, you're simply going to click on this indicator button at the top here, and you're going to search for whatever you want. So for in my example, I'm looking for a simple moving average, and then you'll see there are various different simple moving average indicator that come up, and you can select those, okay? So in my example, I just went for a simple moving average, okay? And all you're going to do is click on it, and it will then add it onto the chart like that. It's that easy, okay? So you'll see here this SMA. I've also got market sessions, which shows the different market sessions. So we've got the London session currently happening right now, and it clearly shows that to me. And I can choose to hide. So if I don't want things to be too busy, I can choose to hide that by clicking this little eyeball here. If I want to change the settings of it on the fly, I simply click on this gear icon here. I can change the settings. So within this particular indicator, I can choose whether to have London session or New York sessions showing, etc., etc. All of these indicators have various different settings that you can change on the fly, depending on what you want to achieve on your chart. So back to the smart moving, to the simple moving average. Here it is on the chart. you can see the line. If I want to hide it for any reason, I want to make my chart a lot less busy, click on the eyeball and it's gone. Click on the eyeball once again and it's back. If I want to change any of the settings on the indicator, you'll see I'll simply click on the little gear icon here, and then I'll click on, for example, style. I can change it to a green line if I wanted to. I can make the line thicker if I want to, like this. So that is a very basic indicator. Okay. Now, another function of TradingView is obviously having different time frames. So if you want to switch between time frames, you can then use this tab at the top here. Now, I've got my 3 favorite time frames, which is the 5-minute, the 4-hour, and the 15-minute time frames. And just to recap, that just basically means, for example, I'm on the 5-minute now. Each one of these candlesticks represent 5 minutes in time. It's as easy as that. Now, if you want to change up your favorite time frames at the top here, or you just want to switch to a different time frame, you click the drop down arrow over here. You can see you can go all the way from 1 minute all the way up to the 12-month chart. So you can go up basically to a yearly. So each one of these bars will then represent a year. Now, what you can then do, if you want to change the favorites, so there's 3 favorites up here. Say you want to only use the 5-minute, okay? You don't want to use the 15-minute, and then you want to keep the 4-hour. You can literally just click the stars, and you'll see now I've just got the 5-minute and the 4-hour. And that's how you customize your time frames at the top here. Now, another interesting feature is changing your candlesticks, okay? So you can now also choose to essentially click on this toolbar at the top here. If you look at the drop down arrow, you can actually change it from candles to hollow candles to volume candles. You can also have a line chart. You can have stop lines. You can have various different chart types. So one that I like to use sometimes is the line chart. So if I click here, it turns the candles into a line chart. And what this allows you to do is very easily mark up zones where the market changed direction. So you can see here, market came up, tapped this zone, and it went back down. And it makes it a lot easier for you to mark out support and resistance zones, okay, which we will come to a little bit later, okay? And I will show you how that works a little bit later. Now, let's go back to candlesticks, because that is what the industry standard is. Now, if we look at the left drawing panel, you've got access to many different tools, okay? So you've got this, which shows you all of the different line tools, essentially. You've got horizontal lines, horizontal rays, which essentially just goes right across the chart. You can then have trend lines, which is also really important. You click on that and draw a trend line, which is basically just a line across the chart. Now, what I've done is I've favorited a few of these. So again, you can just click on the little star here, and it will add it to your toolbar at the top here. So you can see I've got arrows, I've got text, I've got the fib retracement, I've got highlighters. I've got everything that I usually use on the top here, so that I don't have to go in through this menu search for each thing, because I find this menu to be very, very irritating to scroll through, because it's not easy to navigate. So what I would suggest to you, and the most essential things, is to have trend lines, okay? You're going to want to have trend lines so you can draw lines on the chart. You're going to want to have potentially, these two things are a little bit extra. You're definitely going to want to have long position and short position. Now, what that does is it allows you to mark up your position on the chart. So for example, if I wanted to get in a trade right here, I would simply click on long position. If I wanted to get into a long position, it will then allow me to measure out my stop loss and my take profit. And that essentially allows you to see what your risk reward ratio is and plan out your trade. So for example, what this means is that if price comes down here and takes me out, then the trade is closed. But if price comes up here and gets to this level, then that is a winning trade for me. So we enter here, we close here, or we close here, okay? If that makes sense. So it allows you to now plan out your trade. And this is one of the most used tools, okay? And it's a similar thing, it's the same thing for if we're selling the market, if we're in a short position. So if we go short right here, the colors are differing right now. But essentially this blue one is when we're in profit, and the gray one is when we're in a loss or drawdown. So essentially what happens is if price goes up here, we're in the red, okay, we're in the red, and then the trade closes here at this level. If price then decides to go down here, we're in profit, and here the trade will close in a profit. Okay, so this allows you to plan out your trades. It's an essential tool of TradingView. That's actually the most used tool on TradingView. So that's basically all of the tools you need to know about in TradingView. There is, however, an advanced tool, but you need to have TradingView Premium, which is a fee that you pay every month. It's a few dollars every month. It's not necessary, but I do use it quite often. Essentially, it's the bar replay mode. And what this allows you to do is basically, if you click on it and you click on the chart, for some reason it's not working on my chart. So what you can do is go to select bar here, and it essentially allows you to go back in time and hide all of the bars that have happened, and you can click on this button over here, and it's now going to play price forward as if you are trading the market in live time. Okay, it plays each bar, and you can even go into different time frames and then go through the 1 minute from the same place you were at as well. So it just plays the bars forward so you can practice your trading strategy, and this is what a lot of people do. And that is an intro to backtesting, which we will talk about a little bit later. And I'll show you guys how to do that using this bar replay mode on TradingView, because it's one of the essential ways to become confident at trading and become confident in your edge as a trader, is using this bar replay mode, okay, on TradingView to then test your strategy. Okay, so for example, you can put out your profit tool, you can put out your position tool over here. Okay, for example, I want to have my take profit up here, and I want my stop loss down here, and then you can see if that position plays out just by going through the bars. And as you'll see here, we did hit stop loss on this position. So you can actually practice trading this way. Okay, so that's one of the most valuable tools on here. It is a paid feature though, but it is hugely worth it. Okay, so in a nutshell, that is TradingView. So we will go over the next.
Right, so let's talk about calculating lot size. So on Forex pairs, calculating lot size is pretty straightforward. We've spoken about risk management. We've spoken about TradingView and how to use TradingView. And on TradingView, you've got the long position and the short position tool. So this helps you plot out what your long or short position is going to look like. So for example, if we take a long here on GBP, JPY, you can choose the red part as your stop loss. So let's say, for example, we choose 20 pips as our stop loss, 20 pips, and take profit. Doesn't actually matter where it's at, but you can set that at a 1-to-2 risk reward ratio, which will be 40. Okay, we got risking 20 to make 40. Okay, now how do I know, okay, what percentage of my account is going to be risked at this point? Okay, that's what we need to calculate. So if we've got a 100K account, how much of that are we going to risk? Now, as a rule of thumb, especially when you're trading with prop firms, you're going to want to risk no more than 1%. Okay? Never want to risk more than 1%, especially when you're starting out. And a lot of times people risk 0.5% per trade. So if you've got a 100K account, that's $1,000 here and 2,000 that you could win. Okay? So that's a practical example of risk management. And what our job here is to do is to figure out, okay, how do I get these 20 pips of the stop loss to equal 1% of your 100K account, which will be $1,000. Okay, so there are tools that do this for you. So on a site called babypips.com/tools/position size calculator, okay, you can use this tool for free to tell you to calculate your lot size. So the first thing we're going to do is type in our account balance. So if you've got a 100K account, put that in. What percentage of that account are we risking? 1%. What's the stop loss? 20. And what pair is it? It is GBP, JPY. Okay. We're going to find GBP, JPY here. And then what we're going to do is just click calculate. Or we can put in the current USD JPY ask price as well, which would be 191.084. Okay. 191.084, because it does it quite precisely. Okay. Then you're going to click on calculate. And there you go. If you want to risk 1% on your 100K, you're going to use a 9.55 lots. Okay. 9.55 lots is what you're going to be using when you enter that position with a 20 pip stop loss. Now, what if you had a 30 pip stop loss? Then quite simple, you're just going to change it to 30. So if your stop loss is at 30 and you still want to risk 1%, then you simply put in 30 here and then click calculate. And you'll see that the standard lots has gone down. And this is because, remember, you've got a wider stop loss. And so there's more risk on the table. If you stay at the same lot size, it's going to cost you way more to go 30 pips in distance. Okay. So that's how you calculate your lot size with Forex. And you can also do this with metals, by the way. So you should be able to, well, I don't believe they have on here, but there are other calculators that do allow you to calculate for gold as well. XAUUSD is what they usually have it as. This one seems to only do Forex. Now, what about if we are trading indices, okay, which is indexes? And that's what I predominantly trade. So the NASDAQ, for example. What if we want to calculate things a little faster? What if beforehand we know that we're going to have roughly a 25 pip stop loss, like I do with NASDAQ? That's what I do, okay? I enter my positions with a roughly 25 pip stop loss, okay? So this is 25 pips. This is what our position would look like on a typical day. I just took a trade now on NASDAQ, taking this short move here. If I got into a position like here and I wanted to have a 25 pip stop loss, how do I calculate that? How do I know before I get in? Okay, so I'm going to show you that. It's really, really simple. Basically, all you need to do is hop onto MT5 on your phone, okay? Have your MT5 logged in on your phone, okay? And I'm going to show you that here now. And then what you're going to want to do is find NASDAQ. I believe it's US 100. Okay. Again, another lesson on how to use MetaTrader. Once it loads up, you're essentially going to have your chart up here. And what you're going to want to do on here is click on this little clock that's on screen, okay? At the top right, you'll see there's a clock next to these two red and blue tabs. So there's a red and blue clock at the top right. You click on that. And then what you're going to do is select buy limit, okay? And then you're going to click on stop loss. Now, what you'll notice immediately when you place the stop loss, okay, when you place it 25 pips, which is what we're looking to do, it's also going to give you, so in this case, it's going to show 2,500 points, okay? So you see it says 2,500 points where we are. And if we use a 1 lot size, we're only going to be risking $25, okay? That's not enough, okay? We want to risk $1,000. So what if we what if we use 10 lots? If we use 10 lots in this case, you'll see that we are risking $250. So now you're likely going to see that we're going to likely have to use like 50 lots, okay? Now 50 lots gives us 1,255. So we're going to need to bring it down a little more. Okay, so let's say 40. 40 gives us 1,000. So with a 25 pip stop loss, you're going to use a 40 pip stop in this occasion. Now, don't take that as gospel. And I'll tell you why. Because this is an FTMO account. And FTMO accounts have a lower contract size. So if we go back and we go to US 100 cash, tap and hold on that. Okay, tap and hold on the US 100 cash. Should work now. You tap and hold on it and you go to details. So you'll see a contract size for US 100 cash is 1. The third row from the top, contract size is 1. Now, a lot of brokers have that contract size as 10. And what that's going to mean simply is that if you go back to where we were, our 25 pip stop loss, okay, with a 40 lot size, okay, with a 10 contract size, you are going to need to use 10 times less. So you'll use a 4 lot, okay, to get $1,000 risk in your 25 pips, okay? So I hope that makes sense. Basically saying if you have 10 contract size, you need to use 10 times less risk, 10 times less of a lot size than you would if you were trading a 1 contract size like we are here on this FTMO account. So essentially, FTMO's account, we would be risking 40 lots. We would be putting 40 lots on. Okay, and then on a 10 contract size broker, okay, for 10 contract size broker, we would only be using 4. So we would have 10x less, okay? So I hope that makes sense to you guys. Yeah, that's basically it. That's how to calculate lot size on indices and on Forex, as well as gold. Remember that Forex lot size calculators generally have gold included as well. And then with indices, remember that contract size is important. If you've got a 1 contract size, remember that your lot sizes are going to be a lot larger than if you've got a 10 contract size broker. So remember to go to your instrument you're trading, tap and hold on it, and then go to your statistics. And it's then going to show you what contract size you have on there. So let's talk about how to maximize profits and get profits monthly with prop firms. Now, there's specific ways that you can manage risk with prop firms that allow you to get a consistent income. And I thought about this because most of you want to turn trading into a full-time job, right? And the way you would do that is by getting consistent payouts. I mean, you're not going to go to a job and work in a new job where you don't know if you're going to get paid month in and month out. So you're going to want to make sure that you trade in a way that pays you consistently. And I believe that I've cracked the code to that. Now, one thing you need to remember is that prop firms are not real accounts. They are simulated accounts. What this means is that if one account is in drawdown and another account is in profit, then guess what? These do not cancel each other out. So if I'm in a $100 drawdown here and I'm in a $100 profit here, well, I'm actually just $100 up because this does not cost me anything. I am not responsible for any losses that happen on these prop firm accounts. Okay, so it's important to remember that. And so we need to think about risk managing these accounts in a particular way that can maximize the fact that these aren't real accounts. So basically, how I do it is the following, and it allows me to maximize my profit, and it allows me to almost ensure that I get some kind of monthly income from prop firms, because again, majority of you are looking to do this. So essentially what I do is you need to resist the urge, and I know it's hard. You need to resist the urge to spend as much as you can afford on getting the biggest prop firm account possible. So if you can only afford $500 and you go and buy a 100K prop account, okay, this is not smart. This is not smart. Firstly, you've only got one chance to pass, okay, which again, you're not going to pass likely on your first try. What you need to do is aspire to have multiple accounts. So instead, take your $500 and buy 4 accounts of, let's say, 25K. Trust me, you are going to be way better off doing this. Why? I'm going to explain that in a little bit. And what a lot of people will say is, I can make a lot more on 100K, especially if I trade them all at once. And the 100K costs less to buy. You get a discount when you buy a bigger account size. Okay, sure. But remember one thing, if you have one account and you are taking all of your trades on this one account, well, what tends to happen is that some months you'll be in a drawdown, because guess what? Trading isn't consistent. You're going to have months where you are down. You're going to have months where you're up. Okay, that's the reality of trading. What you want to do is get those 4 accounts, like I said, and then get at least 4 and split your risk across them. What this means is on day 1, you're taking a trade on this account. On day 2, you're taking a trade on this account. Day 3, you're taking a trade on this account. And day 4, you're taking a trade on this account. What this then means is that across these 4 days, you just need to win once. Because guess what? Even if you've lost $500 here, you've lost $500 here, you've lost $500 here, and you've made $1,000 here, okay? Because we generally trade with a what? 1 to 2 risk reward ratio, okay? Which means I win twice as much as when I lose, okay? So you've made $1,000 here. What do we then do? If these were real accounts, guess what would have happened to you? Net, you would be down $500 because you got 1,000, you made 1,000, you've lost 1,000, plus you've lost another 500. So you would actually be down $500. Whereas currently, I can go and withdraw this $1,000 and that just gets put in my bank account. Like, that's the beauty of prop firms. So that's exactly what we're going to do. We're going to set this account aside, okay? Put a big fence around it. We cannot touch it. We then wait for withdrawal day, okay? We wait for withdrawal day and we go back to these accounts and start working on them again. Again, what you'll find is that when you split your risk across all of these accounts, okay, when you split your risk across them, what you will find is that you won't be in drawdown for very long with any of these accounts. Because even if you take a losing streak, you've split that losing streak like this across 3 accounts. And what will happen is you'll come back to your first account again and end your losing streak, putting this in a, for example, plus 500. Say we were risking 500 per trade. We've now made 1,000. We've now come back and we've made profit on this account. And we what? We put a big fence around it and wait for payday. Okay. And what you'll find is that by the end of the month, generally, especially if you've got a profitable strategy, which is kind of important with this, and I've done a video on the strategy that I use that has generally a 70% win rate, okay, with a 1 to 2 risk reward ratio. And I've recorded every single trade I've taken over the last 5 months, and I've taken every single trade live, so I can't cheat. All has been live on stream. Okay. If you've got a strategy like that and you split your risk like this, you're going to get paid every month. Even if you are on a 5-6 losing streak that month and you have to spend time making your way back, you're going to get paid every month if you risk manage like this. In fact, you get such an advantage risk managing like this that some prop firms, very small number of them, but some of them have even implemented rules that stop you from just cashing out after just getting into profit. So the rule essentially works that you cannot have one trade make up more than 50% of your profit, which means that if my first trade is a profit and I want to set it for withdrawal, I cannot, because they've seen that people employ these kinds of tactics and splitting risk and consistently withdraw, and it's hurting their back end. Remember, when the prop firm when you make money, the prop firm loses money. They don't want you to make money. And this is a very good way of consistently making money. So some of them have even tried to block this. Luckily, majority don't, and we can use this. Another note with this kind of risk management is that we want to be using different prop firms. We want to be diversifying our risk across prop firms. So do not have the same prop firm for account 1, 2, 3, and 4. Have at least 3 different prop firms for all of these. Okay, please make sure that you diversify, because prop firms can come today and be gone the next. Okay, we don't know. Okay, our job here is just to maximize, get profit as quickly as we can, bank it, and be out of here. Okay, so that is our job, and this is how we do it. Okay, so if you manage your accounts like this, you can consistently withdraw every month because there is lower drawdowns due to us splitting risk, okay, and diversifying our risk among our multiple accounts. And that's how I manage prop firm accounts for a consistent withdrawal.
So here's how to set up a broker demo account. Now, the first thing you're going to want to do is find a broker. Now, a broker is what gives you access to the financial markets and allows you to execute your trades. Now, what you're going to want to do is look for a broker that is regulated, number one. Number two, you're going to want to look for a broker that has competitive fees and good reviews. Lastly, you're going to want to look for a broker that has all of the trading tools that you require, such as trading platform, and also has smooth trading conditions for you to trade with. So next, you're going to want to set up your account. You're going to want a demo account, all right? You do not want to jump headfirst into trading live funds. This is a mistake that many beginners make, and it's going to cost you, literally. It is very dangerous to jump in headfirst as a beginner with live capital. Don't make this mistake. And in terms of trading platforms, I recommend Vantage Markets, which is one of the most popular and well-known brokers in the world. You can get a demo account with them. I'll leave a link in the description for that. But they are regulated and they are very widely available around the world.
Right, so essentially I would head on over to vantagemarkets.com and you can simply click on register. Now, those of you who are living in the US, you're going to have to use a different broker. I believe Osprey Markets works in the US. I'm not 100% sure. Now, if you are wanting to trade now, you click on this. Again, don't recommend that you hop straight into trading a live account. You're going to want to go for a demo account first. So we're going to click on practice trading. And then you're going to want to fill in your details. Now, I'm going to fill in my details over here. Okay, let me just go back one step. So you can also sign in via Google. And my editor is going to blur out all my information here, please. I don't want to get doxxed, so please do some magic there. Select your account, and it's going to fill in your details as so. Again, editor, please blur out my phone number and all other details. And then you're going to put in your details here and just click on create account. And there you go. You should then receive a demo account that is completely beginner friendly and easy for you to get started without having any risk, and practice trading and practice your edge. It's that simple. And then once you've found your consistency, you can move on to trading a very small live account. And that's what I recommend to those of you getting started. Please don't jump straight into trading live capital. As you can see here, obviously my email is already registered, but you will receive your live account via email.
Right, so if you want to trade Forex, of course you're going to want to execute trades. And in order to execute trades, you're going to need a trading platform. So the two main trading platforms and the most popular ones are MT4 and MT5, also known as MetaTrader 4 and MetaTrader 5. Now, what's the difference between them, and why would you keep MetaTrader 4 if there's a MetaTrader 5? Surely the MetaTrader 4 becomes redundant, right? No. So the difference between the two platforms is that MetaTrader 4 is more suited towards algorithm trading or trading with trading bots. Now, so the community around trading bots prefer to use MetaTrader 4. It just runs more smoothly. MetaTrader 5 has some new features which are preferable to use, just down to the fact that they are more innovative. They're easier to use. It makes the platform easier to use in terms of risk management and in terms of being more organized. So we're going to have a look at MetaTrader 5 today because we are manually executing traders, and I'm going to show you how to use it, and I'm going to show you how to make the most of this trading platform. So let's hop right in. So essentially, you can see here, we're under the settings tab on MetaTrader 5 over here. Now, under the settings tab, you can see it gives us some information. It gives us our account information. And what you can do is log into your trading account through the settings tab. So you would click on settings and then click on this top part here. It'll show an account at the top. Sometimes when you download it, it gives you a demo account, which you can use to trade with paper money. And then essentially, if you want to log in, you're simply going to click on this tab at the top here, and then it's going to give you your list of accounts. You're also going to get this plus button over here. Now you're going to click on this plus button. You're going to find your broker, okay? So if, for example, we look for our broker, so say I wanted to use IFX brokerage, I type in IFX, it will come up. You then click on it, and then you're able to put in the details that you get over here. You'll put in your login, and then you'll put your password just below, and then you will be able to log in to your broker. I'm already logged into this prop account, so we will stick with that. Now, at the bottom here, you'll see that there are different tabs, okay? These different tabs allow you to switch between the different functions of the software. So essentially, if you're wanting to look at the different assets you can trade, you're going to click here on quotes. So that's how you kind of get started under quotes. And then you're going to click on this tab at the top here. And that's going to allow you to add your favorite assets to trade. So if you click on this top here, you can kind of create your own watch list here. So you can see these are all of my pairs that I've got under my watch list. And then if you click under here, you can add new ones. So if you click under enter search, enter symbol for search. So say you want to add Euro USD, you're just going to search Euro USD, and it's going to come up here. Now, one thing to note is that all brokers, or some brokers, have different pair suffixes. So what that means is just this like letter afterwards, you'll see some will say like
based on whatever broker feed they're using, they're going to have slightly different symbols next to it, which doesn't actually make much of a difference unless you're trading indices. And indices, you'll see some, for example, with NASDAQ, you're going to have different symbol names. So you're going to have, for example, some brokers might say NAS 100, some might say US 100, some might say US Tech, for example. So that when it comes to indices, they sometimes change. But for Forex pairs, they're generally the same. Just sometimes they have a different pair suffix after. So with this one, it says .r. Okay. So I'm going to click on the plus button over here, which is then going to add that pair to my watch list. So then I click on cancel, and then you'll see here at the bottom, we've now got Euro USD added. So what if we want to trade Euro USD? Because we want to trade, right? That's the whole point of what we're doing. Okay. So you're going to click on Euro USD, and you're going to long press on Euro USD. Let me get it to do its thing. If you just tap on Euro USD, it's then going to give you this menu. Now you can choose either to click on the chart, the details, okay, of that pair, or you can go to statistics. You want to click on chart, okay? It's going to bring up the chart, and you'll see at the bottom, it's going to switch to chart layout. Now you're going to see the candlesticks, okay? So you've got access to the candlesticks of this chart, which is great. Now, when you are wanting to execute, you can do that all from this chart, and we'll go over that really soon. But you'll see as well that I've got an indicator on this chart. This is the 50 smooth moving average. So how did I get that on the chart? I'll show you really quickly. So if you want to have indicators on your chart, all you're going to do is click on this F up here. The F then gives you a list of indicators. Now, by default, I think they probably have the volume indicator on all charts when you download MT5. But I would take that off. I don't really use that. And then you can edit what is on here simply by literally clicking on this. You can swipe left on iPhone, and I believe on Android, if you just hold, it will give you the option to delete. Okay, so you can remove your indicators as you want. Okay, and then you can also add just simply by clicking the plus button. Then you can see you've got Ichimoku, you've got moving average, you've got parabolic saw, you've got ATR, average true range, you've got MACD, you've got movement average oscillator. There's a whole ton of them, okay, and they've all got different settings. But I just use the moving average, and then if you add it to your chart, as I have, you can then click on it and customize it. So I've got mine set to 50 period, 0 shift, smoothed for method, okay, and apply to close. You can also then obviously have different styles, so you can then make your line thicker. You can also change the color of your line as well. So say I want to make it green, you can, or let's make it orange. Cool. And I made it a little thicker. You can also make it like a dotted line. Let's try that out. And then I'm just going to click on done. Okay, then we go back to the chart. You can see it's now an orange dotted line. Cool. So that's how you can add indicators to your chart. Now to zoom in and zoom out, you simply pinch on the screen like you would with a picture or whatever. You can zoom in and zoom out. And then you can obviously go left and right just by going left and right, swiping on the screen. Then you've also got, for example, the crosshairs over here, which then allows you to kind of see where you are in the market. So I can see that at this point here, we are at 1.1908, okay? And then you can kind of see where you are, and you can also see at the bottom, you can also see what date that particular candle was at and what time it was at, okay? Which is quite important, especially with this, because you don't have crosshairs unless you click on this button. And then if you want to then again swipe around on the chart, you're then going to click back on the crosshairs. It'll take crosshairs off, and you can now swipe around on the chart again. So that's quite important when it comes to navigating on MT5. Then, if you want to do drawings on the chart, you can also do that within MT5. If you click on these shapes up here, it then allows you to do drawings. You've got all of these various drawings here. You can do a line, you can do a square, a box, you can do a horizontal, so a vertical line, you can do trend lines, which is what this is, and you've got various other objects that you can add over here. Okay, you've got Fibonacci's as well, you've got Elliott waves as well. All of these are not so commonly used. Most people just use vertical lines, trend lines, Fibonacci sometimes, and then boxes. You can also use the arrows as well, which is helpful. So if, for example, I wanted to add a box, you're simply going to click on the box and you can click and drag. So I clicked and dragged and I can move the box around and have it wherever I want on the chart. What I will say is that TradingView is a much more smooth charting experience, and that's why a lot of people use MT5 to execute and use TradingView to chart. But this can still be used if you're in a pinch, okay? And I do sometimes use the charting tools on here. So that's how you can draw on the chart. You can also add, like, for example, a trend line. So like you can draw a trend line like that, just simply by clicking and dragging on the chart. Then to delete it, you're simply going to click and hold on it. Click and hold, and then you can click on delete. And there you go, it's gone. Okay, so that's kind of like the basics of charting with the software. You're not going to be doing too much charting with the software. Most of it's going to be done through TradingView. Now, how the hell do we execute? So you got to understand that the chart that you're on is going to correspond directly with what you're trading, okay? And so we're on Euro USD right now, and so when we flip over at the bottom here to the trade panel, you are then going to be greeted with the trade panel of Euro USD. And for example, if you then change to gold, XAG USD over here, XAU USD. So if you change to gold, which would essentially mean us clicking on it and going to chart. Okay, now we're on the chart for gold. And then if we click over to trade after that, you're going to be trading gold if you open a trade. So you need to be conscious of that. Now, one thing with this is that the broker is actually cancelled. This account is actually cancelled. So let me log into a different account because I passed this actual challenge account. So let me go to this one over here. So essentially, I decided to go onto MT4 because I don't have any active MT5 accounts at the moment that I'm trading on. And it's also the weekend, so I'm also having an issue getting some of the accounts to work on MT5. But under MT4, we can have a look because it's pretty much the same thing. So essentially, under gold, you're simply going to go under the trade tab. Once again, if you're on chart, you're then going to click on trade, and then you can just simply execute on a trade. Now, you would simply click on buy by market or sell by market and inputting in your lot size over here. Okay, you can then set your stop loss at whatever you would want it to be. So you set the price you want your stop loss to be. You can also click on the trade after this and then change it after. But that's how easy it is to execute on either MT4 or MT5. You're simply going to click on buy by market or sell by market and then input in the lot size that you want at the top. And that's basically the nuts and bolts of using MT4 or MT5. It's really that easy. And the more that you use it, the more used to it you're going to get. Okay, so what I recommend is starting off with a demo account. And from there, taking trades, executing, and getting used to trading the live markets. Do not just jump straight into it with a funded account, please. So that's basically how to execute your Forex trades using MT4 and MT5. So now that you have a demo account to trade on, let's talk about the different types of market orders that you can use to execute trades. Now, the first is a market order, and this is an order to sell and buy immediately at current price. Now, the next is a buy or sell limit order. Now, these are pending orders that are set in a particular price point that is only activated when the market reaches that price.
Now, for example, in a buy limit, you're going to have the price set below current price, and it's only going to be triggered when price gets there. You then, in a sell limit example, going to have to put your sell limit pending order above current price, and once price reaches that point, the sell limit will be activated and you'll beat the trade. And lastly, we have the stop loss order, which we've already spoken about, but essentially this is an order that helps protect your account from unnecessary loss and can protect you from basically risking the entirety of your account. Now you're only going to risk a portion of it. And like I said, a rule of thumb is usually between 1 and 2% of your capital needs to be at risk. So using these types of tools isn't the only way to take advantage of trading. There are a few tools out there that can give you more assets for smaller prices. Now, the first is leverage, and most brokers allow you access to leverage. And depending on where you are in the world, there are different limits to leverage. Essentially, leverage allows you to control a larger portion of a position while having less trading capital. So for example, if you've only got $10,000 in your account and your broker offers you a 1-to-10 ratio leverage, you can actually control $100,000 worth of assets with only $10,000. Now, the next and one of my favorites is prop firms. Now, prop firms are companies that provide traders with trading capital to trade with after taking a small evaluation. Once you pass this evaluation, you then get a live account to trade, which then allows you to potentially withdraw a large percentage of the profit you've made. And this is usually between 70 and 80%. And this way, your personal financial risk is lower because you're only paying the fees for the evaluation that you take in order to get this trading capital. You're not putting your own trading capital at risk. And the best part about this is that you don't have any loss liability. If you lose the funding capital that you are provided, that's not anything that you have to answer for. You simply need to go again and take an evaluation and you'll get funded once again. So for many traders out there right now, their key goal is to get funded with one of these prop firm companies. And once you are past your evaluation stage, you can get funded with anywhere between $50,000 and $200,000. Now, one thing to note is that there are very strict rules when managing these funded accounts. And that generally boils down to a few standard rules, which is generally 10% max drawdown on that account. So you can only lose 10% of that account. And in a day, you can only lose 5% of that account. So if you break any of those rules or surpass those limits, that account is then taken away from you. So be very careful of that. Now, when you're doing the evaluation, your sole job is to, in phase 1, get to 10% profit target generally. Some have a little less, okay? And then in phase 2 of your evaluation, your job is to get to 5% profit target. And again, in both of these phases, you cannot go over 10% drawdown, which means 10% loss, and you cannot lose more than 5% on that account within a 24-hour daily period. But it's also important that you get a reliable prop firm to trade with, because there are some prop firms that do give issues when paying out. But I've never had any of these issues because I do my research behind the props that I get involved with. Now, let's talk about how to find a reliable prop to potentially trade with. Now, the first thing you're going to want to do is look for a well-known prop to trade with that is reputable and has good reviews on Trustpilot. It's very easy to look up the reviews of these prop firms and find out from people that have used these props firsthand. Now, the best way to do that is to go onto their respective Discord channels and look at how often they're paying out traders and look at how many traders are complaining on these Discords. Now, if there is a lot of complaints and very low frequency of payouts, this is a red flag that you need to look out for. But in general, one big rule is to only get involved with prop firms that have been around for some time now, number one. And number two, find out how these prop firms are run and who runs them. This is also important because if there's a lot of money behind these prop firms, the chances of you getting paid out is very high and very probable. They're not going to look for reasons not to pay you. But like I say, in general, prop firms pay out, and I've never had an issue with a prop firm not paying me out. And it's very important to note that I don't recommend that you open a live trading account or get involved with a prop firm until you have a very good trading edge that is proven over time, that you have traded over the period of at least 3 to 6 months and have proven yourself profitable with a demo or simulated account. And this is how I teach everybody to trade. I give them a demo account and tell them to trade it. I want to see profit and consistent profit before you go and spend your own money, before you go and risk things. Because as soon as you start to risk without having reliable data behind your trading strategy, you are just gambling. However, none of these tips about prop firms or trading is going to matter at all if you're immature and freak out when you lose a couple dollars. And I might be sounding a little bit overdramatic, but trust me, there are thousands of traders that struggle with this problem. But once you start to become overly emotional, you start to trade worse and lose more money in this process. And that's why having a very strong mindset is very important in trading. So let's talk about the psychology of trading. One of the biggest problems that traders face in trading is that they struggle to control emotions. Now, a lot of people have a lot of expectations behind their trading. They want to get in this to quit their 9-to-5 job. They want to make X amount of money every day. They want to make X amount of money every week. And because of these expectations, you can then involve a lot of emotions in this decision-making process. And as I'm sure a lot of you know, when you're trying to make a decision and you're in an emotional state of mind, your decision-making is affected negatively. You are not making a logical decision with a level head. Personally, I quit my job way too early when I started trading. I made a couple $1,000s and decided, okay, I've made it now. I'm going to quit my job. And that was a huge mistake. This meant that I had not only expectations, but I had pressure put on myself, not only by me, but others around me. Okay, so there's a few things that you can do to limit this. The first thing is don't quit your day job, right? Don't quit your day job early like I did, because it puts so much pressure on you to perform. And especially if you have a lot of financial obligations. Figure out a way to allow your trading to integrate with your day-to-day lifestyle. So tweak your trading strategy to include hours that works with your day-to-day life and work around your job. Because you're going to struggle. If you quit your job, you're going to self-sabotage yourself and you're not going to make it in this game. Now, another issue that traders deal with when it comes to psychology is FOMO. Now, this is when you decide to get into a trade that you should not have gotten into because you're scared that this might be the one that makes you a whole bunch of money. Now, to limit this issue, again, you're going to want to change your systematic approach to trade. Because if you do that, like I said, for example, I started scalping where I only trade 45 minutes to an hour per day. And this means that I only take one trade and then walk away. Now, the way that I get around FOMO is by having a very particular trading plan that is very well structured. I know exactly what I'm looking for and I stick to that. If it is not presented, then I do not get into it. So make sure you have a very concrete trading plan to follow. This is going to help you get over the issue of your fear of missing out on trades because you know exactly what you're looking for. So why would you get into anything else? Now, another huge problem that traders face is revenge trading. Now, the revenge trading is when you get into a trade to try and make back any losses that you lost previously. And this, again, can cause you to get into trades that is not consistent with your criteria for entry. Now, you want to make sure that you're consistent. You're not allowing past decisions to affect your future decision. And again, I changed the way that I trade to mitigate this problem. I only trade 45 minutes to an hour a day, and I generally only take one trade a day. This allows me to process what happened with this trade that I took and come back fresh the next day, ready to make good decisions in my trading. If I take a loss today and I come back tomorrow, I've processed that loss and I'm ready to make a clear decision that day. I'm not as mindful of the loss that I took the previous day. Whereas if I take a trade a few minutes later, I'm immediately thinking about how I'm going to make back this loss and how important it is that I win this trade. You want to think of each trade as an individual decision. You don't want to be taking a trade based on a previous trade that you've taken and what the outcome of that trade was. So it's important that you treat trading without as much emotion as humanly possible. You want to become stone cold. You want to trade like a robot. No emotion, no feelings. You just execute the same type of trade over and over and allow that edge to play out. And this is the difference between a profitable trader and a trader that just keeps losing money. And that was my full guide for trading Forex for beginners. But as a beginner, I know how difficult it can be to apply trading knowledge on your own. And so that's why I created my very own Discord community, and it's completely free to join. So click the link in the description down below and you can join me every single day, trading live in front of you, taking trades, managing them, and showing you guys my thought process as well as my trading strategy. There are people in that Discord that are changing their lives every single day, and it's completely free. We don't gatekeep anything. We give what everybody else charges for away for free in that Discord. So make sure you hop in there, and I'll see you every single day for New York Open Trading Live. Cheers everyone. Thank you for watching.